Welcome to the Big Skinny with the guy in the tie, me, Lou Bassanese. Hoping you're enjoying this manic Monday because we've got one heck of a week ahead of us. I had to put a tie on. It's so busy coming here. If this is your first time on the show, you're probably wondering, what the heck is this Big Skinny all about? Well, let me tell you. The Urban Dictionary, if you don't have that on your phone, I grew up in the English as an English major with Merriam-Webster, but this slang defines it as insider information. We're not that. I don't want to end up in jail for that. But what we are is essential information that you need and can use in the markets to keep your portfolio ahead. Because after all, if we don't make money together, we're not going to be spending much time together because you're going to cancel me and quickly. So the focus of every show is to make sure that you can sort through all the noise and distill down the information that matters most to increase your bottom line. We do that in a very straightforward format. Some people have called it the sports center of financial news. I'll take it. That's a huge compliment in my mind. I like to think of us as Dave Portnoy of Pizza Reviews, but for investing news. You know, Dave always in his one bite. Everyone knows the rules, except Dave doesn't ever just take one bite. So we try and take one bite out of the news, but we end up taking three, and we give it to you in one headline that you should probably ignore, one chart that focuses on the key data that you need to pay attention to, and then one investment insight. What do you do? What's the action to take in this market? So we're going to go through that today. Before we get to today's rundown, I want to tease you about the episode we have up. We have joining us Stephanie Pomboy to give us the macro perspective that I so desperately lack a lot of times. I'm a bottoms-up fundamental stock picker. Guess what, though? You got to get the macro right. And this is a woman who has consistently been non-consensus, but spot on. Really excited to hear what she has to share with us. That's going to be followed up by James Fishback, the man who literally sued the Fed. Went to a public hearing today. We'll talk with him to see how it went and what's next in this battle to open up transparency at the Federal Reserve and their upcoming market meeting this week on Tuesday and Wednesday. And then, new for the first time here, we're rolling out a new segment where we're going to focus and spotlight young entrepreneurs that are doing something really creative, inspiring, and most importantly, impactful as a CEO. So we have Kennedy Joy Forrestall with us to talk to us about her new app and her new business that I hope, well wishes, takes over the world, but we'll get into why that could happen. Along the way, we want you to join the conversation. Remember, we're streaming on all the socials, well, the ones that matter. It's Twitter, X, LinkedIn, and YouTube. It's make this a choose your own adventure show if you'd like. We'll answer your biting criticisms, your scathing questions, and maybe some stock ideas that you want us to take a look at, or just we may know well. So please don't be afraid to hit us with your best shot. Fire up the comments and questions, and don't forget to go to our website, thebigskinny.com, and sign up for our newsletter, where we send out our insights, one headline, one chart, and one investment insight at a time. With that being said, let's get to this week's rundown. Say it every time. Rocky fires me up, but then when I start looking at that video, like, how did you do that casting call? We need the entire elementary school to chase Sylvester Stallone down the streets of Philadelphia. Yeah, that must have been a fun one. But what's in this week's rundown? Well, let's get to it. I want to keep it short, sweet, and impactful. Don't call it meme mania. What in the world are we talking about? Well, the markets are hitting new all-time highs, 5 in a row last week. And guess what the good old smart money wants to do? They want to downplay it because they've missed a lot of this move. They want to blame it on retail investors and says this, Market Watch, speculative trading's booming again. That's going to turn into a headwind for the S&P 500, according to smart money wizards over at Goldman Sachs, who had to revise their price targets after Liberation Day and revised them down. And now they're revising them up and they're playing catch up. So what's really going on here? Well, first things first, I'll admit it. There is much more speculation going on. You can look at various indicators based upon call volumes that are being traded. If you look at the speculative index out of Goldman Sachs, you see that there is a huge change in the rolling 3-month. But let's look at this indicator here. You see, it hasn't peaked yet. It hasn't hit the manias that we saw in 2020, 2021, and also back in the dot-com days. So what do we make of this? What is the wonderful institutional money saying this? Well, there's a quote from Bronte Capital. Gentleman says that garbage stocks have risen aggressively. How dare you call my stocks garbage, my friend? I think Palantir was in that category. This is an environment like early 2021 when the consensus rapidly became that you should buy frauds because they will squeeze higher. People seriously talked about frauds as an asset class. Well, my friends, frauds are not what are being talked about, but what is fraudulent is Wall Street, smart money, betting short and getting cranky because they're getting their clocks cleaned by going short against Nvidia and Tesla. Well, I kind of agree with the Tesla one. You know I'm not a fan of Tesla. Short Microsoft, have you lost your mind? Broadcom, even Meta, they put profits over principles. I've never been a fan of Zuck, but why are you shorting the stock? It's been booming. It's a 98% driven plus, 98% of revenue driven by ad volume. It's been on a tear. And my beloved Apple, don't bet against them. Here's the thing. Wall Street's sour that their short bets aren't working, that they haven't been buying the dip. But guess what? Retail has, and more power to them. So we're not at a speculative top just yet. The garbage, quote unquote, garbage stocks that are running are actually really good fundamental businesses. We've been talking to you about some of them here. A lot of our guests have featured them in the AI space, humanoid robots, Symbotic. We had Core Scientific that got acquired by CoreWeave. Those are a lot of good individual winners in a market that, I don't know, defied all expectations for the smart money on Wall Street. So what does it mean? Well, it means the smart money is still crying while the retail dumb money, no longer dumb money, keeps buying here. If you look at flows, retail keeps buying up what the institutions are selling. Just focus on that bottom bar on the far bottom, the orange one going left. That means institutions bailing out in mass. Retail on the top, right in the middle, just buying it up. And guess what, folks? I don't see any reason why this trend is going to stop anytime soon. That's why we're bringing in Stephanie Pomboy later on to tell us the risks that we might not be aware of that could give us reason to be a little bit more cautious, but we'll get there. But first, LF Google. I can't swear. I've got young kids watching the show. What does this mean? Well, what's it mean is everyone was dogging, dismissing Google, saying they were getting written off by AI, that they were missing the boat. Is it at the risk of becoming irrelevant? Alphabet stock draws comparison to Kodak. All right. This is insanity. I don't know who the copy editor is over here at MarketWatch. Kodak went bankrupt because they completely missed the digital camera revolution. There's no way that AI is going to pass Google by. They're front and center, and they proved it last week, like I said they would when they put up quarterly results. One of their best quarters on record that I can remember, and it started bringing even, well, many of the bears back to center. Let's start with Gene Munster, famous tech analyst. He says, I've been negative on Google over the past 6 months because of a long-term AI shift. That risk's still on the table, he believes, but search was so strong. Search was up over $208 billion trailing 12 months, in fact, that investors will likely come back to the stock over the next few months. You bet your bottom dollar they will. They've already missed a 20% move. But here's where I get even more excited. Good old Jim Cramer, who has an ETF that trades opposite of his advice. It's doing really well, says, I do think that you take a stock like Alphabet, there's no good news coming from Alphabet, so I don't want to own Alphabet. Oh, Jim, are you eating crow from a month or so ago when you uttered those words? Here's my favorite meme. It's a nice asset you got there. Would be a shame if I were to speak positively about it. So, Jim, keep dogging Google while we keep buying it up on the cheap. Still trading at about 19, just under 20 times forward earnings. Google is one of those stocks that you can buy and keep buying through the volatility here, because if you compare it to the other Mag 7 stocks, it's just not expensive. I mean, you look at the average Mag 7 stocks trading between north of 25 times and 35 times forward earnings. So this is one that you can buy without really hesitating, is my opinion. Maybe I'll get in trouble for that, but we've been doing it for 20% move or so. Let's look at the strength of the business, because I tell you at the end of the day, earnings drive stock prices ultimately. Well, guess what drives the earnings here? It's search. Search is not going away. Search is not dead. Let's effing Google. $208 billion. I mean, they make roughly over $500 million a day from search. It's a lot of money. It's a lot of profits that will drop to the bottom line and propel the stock. So rounding out our rundown here, trying to keep us on track, is I'm fed up and we're going to find out. That's right. I've been forced to wear a tie today. I'm just not doing it anymore. Jerome Powell's fed up with dealing with the president. Fix the collar. The president's fed up with Jerome Powell being a lackey that's just now being political and won't lower interest rates despite all the data. What does this mean? Well, go to the headlines from Bloomberg, and they think a contentious debate is setting up for a fall rate cut. I'm going to tell you it's not going to be very contentious after this week's meeting and more data releases on GDP and jobs and initial claims. It's going to be clear, and I'll tell you to watch the Fed futures market. At FedWatch tool, you watch how quickly the market comes around onto a September rate cut. That means I look like a fool. Yes, that's right. We are either humble here or humbled. And I have been many times on even this program and before for months saying there's no way we're getting a Fed cut in 2024. I was right there. Well, almost got one. And then we shouldn't get anytime soon in 2025. But I've come around. I've gotten better with my thinking. And the data has proven to me we're now behind the curve. Our next guest, well, our guest later in the show is going to tell us how much behind we are behind the curve and how much it's costing us. So we won't waste time with that right now. We'll save it for James. But here's what I want you to focus on. If we just look at market realities, if you take the 1-year Treasury rate and subtract out the trailing 12-month CPI, that gives you a good idea of how much wiggle room there is to cut rates. And either the Fed knows something we don't, or Jerome Powell is going to be proven a clown, because look, the Fed is setting up here for a reality that it has to face. You look at the 20-year average of, I mentioned this 1-year Treasury minus CPI, you got over a percentage point of wiggle room here. So give us 25 basis points, Jerome, please, maybe 50, or give us death. It's going to come. He's going to get fired or moved on out. So let's effing Google and let's get rid of this Fed nonsense. We're going to cover all that and more when we come back from our break. Don't forget to join the conversation live. Well, we do got a comment. All right, hold on. Stop the phones. Hey, Lou, do you have any thoughts on energy stocks like EQT? Also, if you have any updates on Atom and Q. So we went energy to semiconductors to biotech. That's a loaded comment question there. So we're going to hear from an energy stock, my employer, Prairie Operating Company. All in all, I'm just conflicted there, but energy is tremendously undervalued. And if you're playing AI with semi stocks like Atomera, NVIDIA, and Palantir, guess what? We need a heck of a lot more energy. So I think energy as a sector is going to have a rip-roaring comeback. I just can't tell you the exact day, month, quarter, but I'm positioning for my portfolio. Q Biopharma, new data recently. That's right. This is in metastatic, recurrent head and neck, HPV-1 positive cancers, a nasty head and neck and throat cancer that comes back. Great data. Guess why? Because it's keeping people alive, much more so than the leader in the space, Merck's Keytruda. These are great questions. Let's save some for later so we can get to our guests and keep them honest on our time, or us honest with their time. I'm sorry. I'm getting mixed up today. Join the conversation. Sign up for our newsletter at thebigskinny.com or scan the QR code on your screen. We'll be right back after a quick message. Do you believe everyone deserves access to quality health care regardless of their financial situation? Well, at the Roberto Clemente Health Clinic, we make that a reality. And I say we because I've thankfully been on their board of directors for the last 5 or 6 years. In case you didn't know, we're a U.S.-based 501c3 nonprofit that's dedicated to providing affordable, compassionate medical care to the 30,000 people in the Tola coastal communities of Nicaragua, which, if you didn't know, is one of the is the second poorest country in the Western Hemisphere. Now, as a member of the board and having traveled there multiple times with my family and my kids, I've seen firsthand how profound the impact the clinic has on lives in the local area, providing the care that we all take for granted here: primary care, pediatric care, urgent care, and just general wellness education and services. Now, I'm not asking you, I'm not begging you to donate today. I'm just asking you to go check it out and learn more about what we do here. Scan the QR code on your screen or visit nicaclinic.org to learn more and consider making a contribution. Together, I truly believe this because I've seen it happen with my own dollars and with others that are so generous that we can build a healthier, stronger community. We'll be right back.
With me this morning. 2 of the Mag 7 stocks report this Wednesday after the bell: Tesla and Google. I think big tech has to perform. If they disappoint, we're up a creek. What do you say?
I completely agree with one little disclaimer. I don't care about Tesla. I just think it becomes irrelevant in the Mag 7. But I think Alphabet needs to report strong earnings, show that the advertising revenue generation is strong. Mag 7 stocks are expected to report earnings growth of over 14% this quarter. That's going to carry the market because the rest of the unmagnificent 493 are only supposed to report about 3.2%, 3.4%. So
big tech's keeping up with a 14%
growth. Now, profits. Towards the end of the year, the rest of the companies catch up at about 11% profit growth. But right now, right here, for us to continue to forget about the Fed and the drama with the president and to forget about tariffs, we need big tech to step up in a big way.
Why do you think that Google is the best big tech play?
Because everyone else hates it and it's the cheapest. I love to be a contrarian, otherwise you're a victim. It's a stock that I think is one Mag 7 that you can buy affordably at about 19 times forward earnings versus 40 times for NVIDIA and 26 to 30 times for the rest of the Mag 7. So I think there's a lot of concerns over regulatory risk, but I haven't seen anyone break up any big tech companies.
But that is the risk, isn't it? The Europeans are going to have a go at them. That's the way it is.
Yeah, it is. And look, it's a real risk, but I don't think it's going to come to the point where they're going to break up Google's business.
Do you have the guts, shall we say, to buy Google in advance of the official numbers?
Some of us buy things in front of earnings. I think Google, yes, I know with Netflix. With Netflix, we talked about that last week. I have no fear buying and adding more to Google ahead of earnings. If it dips after earnings, I think, again, it's a low risk, high return potential for me.
All right, Lou, stay with me for the full hour, please.
Welcome back to The Big Skinny with me, Lou Bassanese. You know we're having fun when your wife texts you and goes, I just turned it on and you were stripping. That's not a good sign, folks. We're PG here always, but I want to tell you, we're not PG with our takes on the market. We're ruthless if we need to be. And our first guest today, what I appreciate about her, we've spent time on Maria Bartiromo's show multiple times, is that she always is data-backed, data-driven, but cuts through the noise and the BS. So I'm hoping that she's got some no BS take for us today because I need it. Well, let me welcome to the show Stephanie Pomboy, the founder, president of MacroMavens. How you doing, Stephanie?
I'm awesome. It's a pleasure to be with you here on The Big Skinny, Lou.
I know. I like it. What do you think? Everyone doesn't know what to think of the name, but I think it's fun. So we're rolling with it.
It is fun. I mean, this business is serious enough. Can't we just let our hair down and have a good time?
Amen to that. Listen, I got to confess, I probably made a mistake on TV today. I was talking about like second half of the year. I don't really see anything that could undermine this bull market. But then I did make one comment knowing that we were talking later. What's scary to me is that I'm not scared about anything. So I knew we would be talking and you could give me some insights on what should we be worried about right now, right? We're getting tariff and trade deals done. The big, beautiful bill passed. What's lurking in the shadows that could really undermine this current market rally, in your opinion?
Well, this is a softball pitch down the middle for me, Lou, so thank you, because, you know, my whole self-imposed mandate is to identify the unseen risks that no one's really recognizing. And there's a major shadow lurking that is already eroding people's returns, and they're unaware of it. So I would not argue with you. I'm not going to arm wrestle or do a wager with you as to whether the stock market's going to continue to power higher into the end of the year. What I will say, and has been the case, is that paper assets have been underperforming hard assets for more than a year now, but they've really trounced paper assets this year. So
you're talking about like gold mining stocks, which I believe you were early on pounding the table to buy gold mining stocks. Am I right?
Yeah. I mean, I started years ago talking about gold, the physical metal, as a way to hedge your portfolio against dollar debasement, which I thought would be forthcoming. And so you did have that. And now the gold miners are starting to take off just because it took a real legitimate increase in the gold price to persuade people to buy these crappy companies that are legendarily, poorly managed.
Traded on the Vancouver and promoted by shysters, but still levered to gold prices. Yeah.
I mean, it's a very checkered group of companies, so you've got to do your homework. But what I will say is so far this year, gold, the metal, is up 26%, even after all the drawdowns we've seen in the last week, and the S&P is up 8.5%.
Yeah.
So
do you think that was just a delayed response that played catch up, or do you think it continues now too with the continued deficit spending, et cetera?
Yeah. So, I mean, this is sort of my overarching thesis is, and has been for a long time, I'm kind of a broken record, that our fiscal situation is so far gone that I know the administration's trying everything they can to get us to a position where we can accelerate growth and at least grow the economy faster than interest expense. But at this point, we're 37 trillion. There's no way we're growing our way out of our fiscal problem. And all we have to do is have, stub our toe economic wise, a recession or a downturn to have the deficits mushroom again, so the efforts that Doge made will go flying out the window if, we have a quarter of negative GDP. So we have no wiggle room for any kind of error here. in terms of economic growth. And so as this all comes full circle to the Federal Reserve conversation that you teed up earlier in your monologue, and this fixation on the Fed funds rate is one that I find fascinating, because it's another thing where everyone's focused on one thing and they're missing the real story. And that, in my view, is the Fed funds rate. It's not even clear, based on market action, that lowering the Fed funds rate is going to bring interest rates across the curve down.
Well, I mean, look at the last time Powell lowered rates. The bond market said, "Yeah, we don't trust you, we don't believe you, and we're going to jack up yields and go north to 5%." So, do you think that happened? Like, let's say, I mean, I don't think, you correct me if you think otherwise. I think there's 0% chance of a cut this week, but September there's probably a really good chance. Do you think the bond market responds positively or negatively again, like it did last time?
I think that Trump, last Wednesday, was it? It seems like a year ago now, that he we woke up to news that he was imminently going to fire Powell, and the bond market sold off on that news. And then he looked, I think Trump did this to kind of test the market. Let's get the market's opinion of what's going to happen. And as soon as he got that information back, he immediately said, "No, I was never thinking about firing Powell." So, I think he's clever like that. He wants to see what the market reaction is. He put it out there. He got an answer. It wasn't the answer he wanted. And subsequent to that, he's been a little bit more restrained in his criticism of Powell, let's put it that way.
It's got to be hard for Powell because he knows Trump hates him. But to your point, Trump is the master of reading the room. I think he thinks it's better to buy the rumor and sell the news. People figure that out if he replaces him or announces a shadow Fed. So just keep threatening to replace him, and that'll keep the markets calm. I mean, do you think that's the case as well?
I really think what he should do is, just rather than waiting till December to name his replacement, name it now and get that guy, whether it's Kevin Warsh or whoever it is, to start giving speeches and going on CNBC and Fox Business and talking about what his policy is going to be, because then he basically takes the podium out from under Powell. Powell becomes a lame duck the minute Trump announces his successor.
So
no one's going to care what Powell says.
So basically take a page from Trump's playbook when he won the election and just started having pressers and telling everyone what he's going to do. And
exactly.
Yeah.
So I don't know why he doesn't. Why is he waiting till December? Do it now if you're really fed up with Powell, and you completely neutralize him. He becomes a lame duck immediately. But what I was getting to in this whole thing is that the balance sheet is where all the action is going to be. And that's why I, started out being long gold, and now I've kind of tried to diversify into the gold miners, is that I think that it's just a matter of time before they end up having to re-expand the balance sheet to absorb the massive amount of treasury issuance. I mean, this year, over the next 12 months, we have $7 trillion in debt that comes due. People think, well, the deficit's $2 trillion, so we only have $2 trillion in debt that needs to be refinanced. But the fact is, because Yellen financed all the debt with T-bills, we've got a tremendous amount coming every day that needs to roll. So we have $7 trillion in 12 months, and our foreign creditors are all running in the other direction. I was just looking at this number a couple of minutes ago. In the last 3 months, foreign central banks have sold $60 billion worth of treasuries. So if you annualize that, we're talking about $240 billion in sales by our one-time creditors, which isn't going to help us.
It's not going to look good. So let me ask you this. What's the solution out of this outside of government slowing spending, which is not going to happen? Do you see crypto as an answer, the whole move to basically make it acceptable to have stable coins, which essentially just buy treasuries? They become a huge customer for the government. I mean, is that the new solution that's palatable to the markets, and we just kick the can down the road? Or do you see, this is what I respect about you. There's a question here. I promise that you have been banging the table about just runaway spending. It's going to have an impact on gold and inflation, but you're not a doom and gloomer like a Peter Schiff that's been just incessantly saying the world is ending, yet, find some, you find the golden thread somewhere. So where do you see that? What is the next logical step that happens from here?
Well, I think like I said, in nominal terms, the stock market and paper assets can continue to move higher. It's just that in real terms, you'll be lucky if you stay even with the dollar debasement. But one thing that's interesting as relates to crypto, and I'm not, I prefer gold. I just don't, I'm an old woman. So I'm a Luddite. I belong in a cave. I don't understand the allure of crypto whatsoever.
You
If I
like
can't touch it and hold it,
tangible assets, right?
yeah,
Not
I need to be
intangible
able to
digital
hold it
assets. Yeah.
or wear it or whatever. It's got to be something I can enjoy.
Hey, I came from Jersey, so I understand wearing gold. So,
Okay, I love it. You're not showing your pinky ring, but I'm sure you've got one.
I got some cousins that have that, but we won't talk about them.
Oh my God. But what I was going to say is that comes back as well to the hard asset paper play, because not just, obviously the impetus for establishing these cryptocurrencies was to create an alternative to fiat money. But the interesting thing is, if you look at, let's say, MicroStrategy, which has been a barn burner because it's a levered bet basically on Bitcoin. And you think about that as, one of the hot areas. And then you've got AI, the other real powerhouse driving the market higher. I mean, essentially, those are the twin engines of this levitation in the stock market. But they both rely hugely on energy, like basic resources, to say nothing of rare earths. Like, you need to have that underlying resource, and that underlying resource is scarce. The ability to create paper claims is infinite, but the future of AI and the future of crypto is only as good as their access to those basic resources.
I swear she's not reading off of my cheat sheet. I started working, you know me, I've been a tech guy for 20 plus years, and I started working with an oil and gas company in January because I realized, one, the president was bringing in a new regime that was going to favor American energy independence, but two, the biggest tech trend of my lifetime was never going to happen without energy, reliable energy. And I mean, I've been sharing with people that, China's kicking our butt in terms of energy generation, right? They're not ahead of us in terms of AI tech, in terms of AI company formation, but they have brought online almost 9,000 terawatt hours of energy in the last 20 years. We've brought on a measly 800. So I think, why do you think so many people are missing this major ingredient and enabler? And where do you see it playing out?
It's just not sexy. It's much more fun and exciting. It's the fact, right?
True.
Who wants to talk about rare, basic rare earth minerals and oil, and when you could talk about NVIDIA and crypto and Bitcoin and all these things that are going to the moon? That's exciting. It's the shiny new toy. Oil and rare earths have been here since before you and I got here, so
no,
it's just
the
not
truth.
that exciting. It's not new.
I'm out there. I'm glad to hear that there's someone else out there that's championing the same reality. I mean, we're not novel ideas here. It's just a fact of economics. You can't power all these data centers unless you find all forms of energy, right? Natural gas, oil, coal, solar, wind, nuclear, you name it. Before I let you go, I know you have a hard stop here, but any other insights that you think people are just missing in this market that they need to be paying attention to from a macro perspective?
Well, I think the number one thing that people are missing is that they're being silently debased through this decline in the dollar. And yes, the dollar's rallied a little bit in the last week, but it's down 10% this year. So if you're not paying attention to your real returns, you're missing it. So I think that's very important. And again, I would underscore that rather than fixating on what happens to the Fed funds rate and whether it's going to go down 25 or 75 or how many basis points in the next however many months, think about the balance sheet and the possibility that that ends up being enlisted again to help service our enormous debts in the absence of those foreign creditors used to do that. And then I guess the final point that I would make that is not popular and sort of gets missed in the mainstream coverage is this idea that the low and middle income households in the US are in recession. And that's not a statement about Trump. I think they've been in recession for 4 years, and they're starting to get some relief in the form of, reduced inflation. And we'll see if they get relief in the form of lower interest rates. I'm highly dubious about that part of it, but they should hopefully find better job opportunities as we reshore some production and bring, really strong manufacturing back to this country.
That's a great point too, and it's starting to show up in the data in terms of blue collar wages. They were down 1.7, almost 2% under Biden in the first 5 months. So that was in 4 years. In the first 5 months, they're up 1.7%. So you need to see that trend continue. Listen, always appreciate your insights. I know we'll see you this week. I'm sure on Maria Bartiromo's show sharing those insights. So I encourage people to tune in, to check out your website at MacroMavens.com, and would love to have you back when I start getting way too bullish and need some grounding.
I will be your resident mistress of doom anytime you need it.
Love it. That's your moniker from here on out. That's what we're putting on
the
cover on next time. So Stephanie, thanks again, and always a pleasure.
Great to see you. Thanks, Lou.
All right. Well, if that didn't sober you up to the reality that as we speak, your dollar is being debased, it's the truth that you need to be investing in ways that can outpace inflation and dollar debasement. We've talked about Bitcoin here with several guests, but we've also talked about gold. And yeah, it's a barbarous relic, as many referred to, but the data is the data, the performance is the performance, and it's done very well catching up. So again, always all these alternative assets have a place in your portfolio. If you're wondering what I think about it, I don't know, opine, ask me a question in the comment section before we finish this show. With that being said, we are going to take a quick break before we bring on our next guest, but don't forget to sign up for our newsletter at thebigskinny.com or scan the QR code on the screen. Attention investors, are you looking for a high growth opportunity in the energy sector? Or are you just looking for the ad that you're supposed to read? That's what's going on here, folks. I got a little sidetrack. Well, look no further than Prairie Operating Company. They're trading on the NASDAQ under the ticker PROP. As America's premier high growth, low cost oil producer and an enabler of the AI trend, which we just talked about with Stephanie Pomboy, Prairie's making waves in the DJ Basin, which is in Colorado. With a recent transformative acquisition, they've expanded their footprint to 55,000 net acres, increased daily production by over 25,000 barrels of oil equivalent. In case you didn't know, that's a lot. Prairie's poised for growth, even more ahead, maintaining a strong balance sheet while delivering value to shareholders. So don't miss out on researching this exciting investment opportunity. Prairie Operating Co., PROP, on the NASDAQ. Full disclaimer, I am an employee of Prairie and deeply conflicted, and past performance does not guarantee future results. So, with all that being said, consult your financial advisor before considering investing. We'll be right back. That would supercharge the economy and the stock markets. I'm cut from the same contrarian cloth as Charles, except my cloth is never as fancy as his. But I hate it when everyone thinks alike. There's that Humphrey B. Neal quote that says, when everyone thinks alike, everyone is likely to be wrong. Right now, this is the most hated bull market out there. You look at short bets against the small cap index, the Russell 2000, at a record high at 16 billion right now, even though small caps are up 29% off the Liberation Day lows. I look at earnings. You talked about that too. Earnings ultimately drive stock prices. When we talk right now, Mag 7 is going to have 14% earnings growth this quarter expected versus 3.4% for the rest of the index. Get out to Q1 in 2026, and it's about 11% for both of those groups. So the back half, the unmagnificent 493, are about to be supercharged because of capital investments. AI, I don't think we've really factored in the growth from AI. Contributed 1% to GDP growth a full percentage point. You're going to see more of that come in the back half of the year, plus tax cuts, plus maybe some real estate gasoline in the form of a exclusion for capital gains. I think it's all stacking up here. Welcome back to the Big Skinny, where we just roll with the punches sometimes. I say dumb things. I have to correct myself. We also sometimes have to deal with guests that have bigger commitments than us. That's right, folks. There is more things important than the Big Skinny. I mean, not in my life. I mean, I know, but it is. James Fishback, unfortunately, had texted because he did sue the Fed today. There was a public open hearing, Here I am in a lowly podcast video live streaming guy, and this guy's suing the Fed. Well, he's got to meet with his lawyers after his attempt today to open the Fed market meeting to the public on tomorrow, and Wednesday didn't go as well. So he did promise he'd come back the next time. So let's see where this adventure goes. We talked about this being a choose your own adventure show. The good news is we have another guest that I'm going to argue is going to be even more famous than James Fishback when she finishes what she's doing. She's just getting a start. We're talking about the new segment we're doing featuring young entrepreneurs It's a spotlight we want to shed on young people that are doing really entrepreneurial and innovative things, and we want to support them in any way we can. If that's just getting the word out, if it's maybe providing some investment support, that's what this segment is all about. And I am thrilled to kick it off with Kennedy Joy Forstall, who is the founder and CEO. She's maybe 21, 22, and already a CEO of the Raid app. Check it out at www.raidapp.com, and welcome Kennedy Joy to the show.
Hi, Lou. Thank you so much for having me. I'm happy to be here.
Listen, I've got to ask, tell us about the Raid app. What does it do, and how did you come up with this idea when most people like myself at your age were just figuring out, I don't know, where's the next happy hour I'm going to? Yeah. Damn the man.
Absolutely. Absolutely. Well, I can't lie. I've had plenty of those as well. But Lou, I've always found that the most meaningful solutions often emerge from the everyday struggles that we all share. So I don't know about you, but for me, that was the constant feeling of I have nothing to wear before college events, despite having a closet full of clothes. So each week brought a new social or themed event, each with a specific dress code. And I didn't want to keep spending money on outfits that I knew that I'd only wear once. So I'd raid my friends'
not
closet
cheap
first.
outfits either, right? I mean, these are expensive outfits for socials and formals and game day.
Absolutely. Absolutely. As we know, the price of everything just keeps going up. And for college students, even, those who are turning to fast fashion alternatives, I try to raid my friends' closets first. But if they didn't have what I needed, I knew someone on campus definitely did. And that is where the idea for Raid ultimately started. And I realized that I wasn't alone quickly either. This was happening on every campus. Students were either overspending on fast fashion or scrambling to swap pieces last minute. And that's when the idea really clicked, to have a peer-to-peer clothing rental app that allows college students to borrow and lend outfits within their own college campus community. It connects students who need something new for the night with others looking to make extra cash, meanwhile preventing all of those single-use purchases.
And this is not just a goodwill venture here. There's a fee associated with it. So tell us about the business behind it and how it's not just about renting clothes, but there's a sustainability motivation behind it as well.
Absolutely. So, women have been borrowing clothes from each other for forever. One of the reasons why I love that idea is it wasn't an unproven concept. Raid just takes that age-old habit and makes it frictionless, scalable, and as you said, profitable. But beyond just making the fashion more affordable and accessible, Raid is also helping shift that behavior in a more sustainable direction. So Raid makes a profit by taking a fee from all of the transactions that take place during transactions on the app. But what began as a simple idea has definitely grown into a vibrant community of students.
Yeah, I wanted to focus on that because I think the tendency always is to feature young entrepreneurs and they have an idea, right? Or they've got an app built, but the business doesn't have any legs yet. The one thing when talking with you that amazed me is how much traction you've gotten already. This is a real business that's hustling and bustling on multiple college campuses. So talk to us about the scale you've already been able to achieve in what short period of time.
Absolutely. So we launched first at Florida State University, which was my alma mater, my co-founder's alma mater.
Go Gators, reluctantly. I'll throw that out there.
No, none of that here. I will log off right now, Lou.
All right, never mind. I'll say it for national television and for here on the spot audience. I'm a Knowles fan for another 7 minutes.
Well, thankfully for both of us, both of our alma maters now have Raid. After we launched Raid at FSU in October of 2023, we soon got that popular demand asking us to come to the other major universities in Florida, including UF. And so we are there. We are at UCF. We're at all major campuses in Florida, and we've expanded past that since then, going to other campuses throughout the Southeast.
And then what are the next expansion plans, right? So you are young, ambitious. You've got a team behind you. This isn't just you figuring this out on your own. Tell us really about the rest of the company and what the vision is for the next 12 months. And then what do you need to get there?
Absolutely. So we are continuing our expansion. We'll be servicing 20 campuses across the Southeast this fall, including campuses like University of Georgia, Texas A&M, University of Alabama, Ole Miss. And we already have a wait list from over 60 universities where students have begged us to bring Raid next. We're currently working to close our first pre-seed round to directly aid in this expansion. And while Raid is campus-based today, the long-term goal is absolutely to build it to grow with our users. So we envision a future where post-grad communities and cities have access to shared closets that are accessible, affordable, and community-driven. And we've actually already had this exact request from graduated users too, wanting to bring Raid into the next chapter of life with them, which I think is really cool.
Yeah, look, Facebook, I'll say it. Congrats on all you're doing. Facebook started in college and now has taken the world over, literally billions of users. So there's no reason you can't scale past that. Listen, I was an investment banker for 3 years, and I know the hardest thing to do is tell people you're raising capital. The even harder thing is to be the CEO behind that's raising the capital. I know you're in the middle of that now. I want to put it on the screen in case there's any people that could. Sometimes it's not just the money, it's the investors that are connected to that have those relationships that can help you along the way. So if there's someone listening today that feels so motivated to help this young entrepreneur that we're featuring, that's the purpose of this here, to get the word out, but to also get them the resources, some mentoring, guidance, things that can help them accelerate their business. You can email Kennedy Joy directly at KJ@Raid app or scan the QR code on your screen. You can go check out the app, the website, and get more information about it. Kennedy Joy, with your permission, I'd love to have you back when you've got some key milestones. So just reach back out to us, let us know, and we'll love to talk about your future success.
I would love that so much. Thank you so much, Lou, for having me on today.
Well, congrats on all you've accomplished so far, and I'm really looking forward to congratulating you on what's next. You got a fan here in George saying, go KJ. So I think there's going to be a lot more of those in your future. So congrats, and we'll talk soon.
Talk soon, Lou.
All right, folks, we launched this segment because it dawned on me that young people, men, women, boys, girls, are up to so many creative things. And I said this on air in a recent Fox Business special, that there's never been a better time to be alive to start a new business, because things are so much easier now. The internet, the digitization, the ability to scale and do things and rent software as a service to fulfill all these business functions that used to take an entire team. And I think Kennedy Joy is onto something here, clearly scaling to 20 college campuses. I think I visited 20 college campuses during my career, but really proud of what she's got going on. I want to encourage you, again, the motivation here is to give young entrepreneurs a leg up, whether that's capital or resources or connections. So if you have any involvement on a college campus or are a venture investor or just feel motivated to reach out and find out more about what they're doing and how you can help, please shoot KJ an email or check out what they got going on at the Raid app. And with that being said, we're going to bring up our next block, the Dodd block, to get to this week's High Five. My man, Mr. Dodd, what's going on?
Hey, Lou, you're looking good, man. I hope the verdict was favorable.
The verdict was favorable. Guilty as charged.
I feel
for saying preposterous things online. Listen, my friend, we've this is episode 17. I don't know how we got here. This is the time of the episode where we do a little bit of reflection, look back, look forward. For people that are joining us for the first time, I want to thank you. For everyone that's joined us multiple times, I want to thank you as well. This is where you and I, like we always say, be humble or be humbled in the markets, right? It's inevitable. If you get arrogant, you get a beat down. It's like growing up in Jersey. You run your mouth a few too many times and you're getting smacked down on the basketball court. But we bring up 5 things, revisit topics, but sometimes I tend to forget what they are. So you keep me in line.
I'm pretty sure you're going to forget a few today, Lou. I have a feeling.
All right. Well, you want to get to them? Let's get to the High Five.
Let's do it.
The same feelings that I get when I watch Rocky and my face superimposed on him, but I'll take it.
Come on,
man.
Dumb and Dumber was the best, like one of the best movies ever. Gotta love it. We're gonna work
All
Tommy
right.
Boy
All right. Yeah, Tommy Boy. I'd argue Tommy Boy's up there. I mean, if you're watching online and were born before 1990, maybe you saw those movies. Let us know what your top hit is and let us know if you got any questions. Join the conversation as we go through here a rundown on things that we got right, wrong, or the verdict is still undecided.
You know, Lou, I got to say, I kind of feel like the Vanna White of our show. You know, Vanna,
that means
Vanna
you got to
turns
wear
letters.
a dress, high heels, and change your background before next week, my friend. So That challenge accepted. If everyone agrees, chime in. It's happening. Too late.
Do you know
Decided.
she's been turning letters for 41 years, getting paid turning letters. 41 years.
What did we do wrong in our lives, Todd? All right. Anyway, AI savior. What is going on?
AI savior. This must be Trump talking about himself and his new big announcement last week.
Hey, it's a really big deal. No, look, we've talked about this, and Stephanie Pomboy got into it, that energy is the key enabler of the AI boom. I've been arguing recently on appearances that AI is the key enabler of deflation and future economic growth, and now we get some validation of that, right? I had a hunch and some data to back it up, and now Torsten Slok out of Apollo, who, if you don't follow him, the Daily Spark, I don't know how he comes up with all these great data points to analyze each week or every day almost. Check it out. But here he goes, shows the CBO forecast for federal debt, and then he layers on if AI does all it's expected to do, and you see it basically slows and stops the progress of deficit spending. So this is a huge opportunity. You know, Stephanie talked how we can't grow out of $37 trillion in debt. Yeah, but we can at least stop it from increasing with AI. So AI could be our savior. And also, if you listen to the deceased Richard Dawkins or Stephen Hawking's, sorry, if you're Richard Dawkins, you're not dead yet. Listen, I'm dyslexic at the end of the show sometimes. At least I'm remembering. You know, AI could be our savior or the end of us. So, you know, to be determined. We'll hopefully live long enough to enjoy it.
All right. Biggie Smalls. I wish we were talking about some, old school rap, but something tells me we're talking about the big comeback for small caps.
Biggie Smalls and the big comeback for small caps. No, it's the big valuation gap that small caps are trading at with large caps. We haven't had the big comeback yet, so we're betting on it. I still think here, look, supercharged growth in the U.S. and in the back half of the year is going to lead to a lot more favorable view of small caps. They're undervalued, unloved. Wall Street hates them, which Wall Street hated Google a couple months ago, and they're coming around to it. So I think small caps are going to come around. They're going to come around to small caps, and we'll see a huge rally. So that's usually what happens as we get later in the beginning of a bull market, and then later into the bull market, small caps really shine. So I'm betting on it, and so is my portfolio. So,
all right, V-shape. We must be talking about my chiseled physique, right?
Yeah, no, we're the deep V t-shirt that I wear at Jersey, right? No, the V-shaped recovery here, we talked about this. Everyone was asking as the markets were selling off, is this going to be a V-shaped recovery? I predicted I thought it would because of the fundamentals, but here's what we're seeing now. This shows the earnings revisions by analysts who are like weathermen. They're right 24 hours out, but miserably wrong many further out. And they immediately started cutting earnings guidance. And lo and behold, we're, 30, 40% into this earnings season, and they're having to revise upwards their earnings guidance, which just shows me that we're going to have a lot more guidance changes to the positive side as we move through this year, which isn't being priced into the market. So I said it earlier that, I was a little cautious, but I don't see anything getting in the way of this market rally. If earnings keep growing, then multiples, you can grow into those multiples that everyone keeps bemoaning.
All right. High and Higher. I'm praying this is a Cheech and Chong revival. Is this a new movie coming out? Come on.
We don't have those graphics. If it was, you would have had a graphic for us, my friend. You're the wizard behind this. Yeah. No, look, here's the other thing. And I think I'm flirting with the idea of sending out a newsletter article like the one we did, Top 10 Reasons We're Not in a Bear Market, which we were right in March when we sent that. Top 10 charts you should ignore about this being the top of the bull market. And here's what everyone keeps citing is that, we keep hitting new all-time highs. That means we got to get close. It's got to be closer to rolling over. No, absolutely the opposite. All-time highs lead to more all-time highs. And if you look at how many we've had this year already, it's really not on a record pace. I mean, if you go back to the booms of 2020, 2021, 1995, dot-com days, we get north of 50, and that's when you have to worry about market top. Right now, we're at just under 20. So more than halfway through the year, we're not in danger territory. So I think, again, another indicator that don't fall for the nonsense being peddled in the headlines. Focus on the data. The data tells us all systems go.
All right, that's good to hear. 100-year chart. I'm betting this is $100 that this is the one you forget.
It is the one I forget. It's a prediction I'm making for 100 years from now because I'll be dead by then and it won't matter what I say. The predictions, that was always my problem with futurists, right? Have you ever know any futurists like Peter Diamandis and some of those other guys that get out there and they just say, I bet in 50 or 75 years, these are all the trends that are going to matter. Well, great. You're never going to be held accountable because you're going to be dead by then. But I don't remember what was, next 100 years.
See, I was right.
Listen, that chart, if we bring it up again, if you show, it's anything the government's involved with gets inflated to high hell. If you look at college textbooks, college tuition, hospital services, if you look, anything red and going northward is well above the pace of average inflation. So average inflation checked in through June at like 75%. But then look at the blue lines. You start looking at technology. It's deflationary. TVs, computer software, toys, which are all digital now. New cars, over 30% of cars now are semiconductors. So tech is deflationary, government is inflationary. Get the government out of the way, let the tech progress continue. That's a reasonable solution to the deficit spending that we've gotten into. I wish Doge would have went further. They didn't, but I think it's a good start. How's that for figuring it out on the fly what the last 100-year chart was?
That's pretty good. Just show you the picture and then you can figure it out. That's good.
Oh, the picture. Look at that. Dodd man with his deep
V.
Yeah.
I thought that was the V shape we're talking about.
Yeah, what people don't realize is that we did have a few pictures that preceded that one, which was, President Trump and Elon Musk superimposed on bodies too that were a bit more humorous. And then you took it upon you took creative license to make yourself look svelte. But listen, we are live on multiple platforms. If you ever have a comment, question, if you forget about it after the show, well, too bad. Tune in next week. No, shoot us an email at info@thebigskinny. While we're live, you can always comment and opine on what we're talking about. Don't forget to sign up for our newsletter at thebigskinny.com or scan the QR code on your screen. That does it for us. That's a wrap. We're going to shut her down a little bit early. There's a big week ahead of for us in data. We'll be back next week. We're going to rekindle the humanoid robot war debate. Got Chris Camillo of Dumb Money TV, who's going all in on humanoid robots. If you haven't paid attention to my stance on it, go back to last week's episode where we had Adam Johnson of Bullseye Brief and the American Ingenuity Fund, as well as Mike Lee of Mike Lee Strategy, trying to convince me why I need an Optimus robot in my home and why I need more Tesla shares. Well, I need some Tesla shares in my portfolio. Not buying it. But we're going to revisit that. Chris Camillo, who's a very successful investor in his own right, no Wall Street background, proves that you don't have to have an MBA, go to Wharton, work on Wall Street for Goldman to outperform the smart money on Wall Street, which is something we firmly believe here too. And that's our mission at the end of the day, to help you sort through the clutter and the noise to bring you information that's profitable and increases your bottom line. So that's a wrap for this week, episode 17. Thanks for tuning in. I'm Lou Bassanese signing out. Thank you, Dodd. Thank you, Dan. Thank you, Taylor. And I think the intern's name is Sam, if I remembered it correctly. So thank you, Sam, for all we do. You're not the intern anymore. We got an intern.
All
yeah,
right.
You graduated. It's promotion day for Dodd.
Oh, so I'm getting promoted. I'm not out.
You're not out, dude. You're promoted. You're not fired.
All right.
All right. Thank you all for tuning in. See you next week.